What is asset? Asset is present economic resource controlled by an entity as a result of past events. Actually, assets are properties of the business and are categorized in two types: current asset and non-current asset. Current assets are assets that business expect to convert it into cash, sales, or use up within. Hello everybody, my name is NIBYOSE Elie. I'm certified accounting technician. Today we are going to discuss on double entry system. Not just rules, but mathematical and economic reasoning behind it. On this channel, we explain accounting, finance, and also business concept from foundation level to advanced level. If you truly understand this topic of double entry system, you understand language of business. So be with us in this video. Let's proceed. Thank you. At the end of this video, we will understand how asset, capital, and liabilities of the business are connected, and you will understand the logic of double entry system, how every transaction affected the decision of the business, and why this knowledge is essential for making financial decisions. By the end of this video, you will not just memorize the numbers, but you will see the financial story of any business clearly. Double entry system is a system that keeps business record or financial records balanced. Its foundation is duality concept that states that every transaction affects at least two accounts. So, what is accounting equation? Accounting equation is a foundation of double entry bookkeeping. It shows the relationship between assets, liabilities, and the owner equity of the business. Accounting equation shows that what belongs to the business or assets is always equal to what business owes or liabilities plus what belongs to the owner, or what we call owner's equity. For example, this machine cost 500,000, and when I purchased it, I had 300,000, and I borrowed 200,000 from another person. To sum up to, it cost 500,000. That shows that asset equal to liabilities plus owner equity. What is asset? Asset is present economic resource controlled by an entity as a result of past events. Actually, assets are properties of the business and are categorized in two types: current asset and non-current asset. Current assets are assets that business expect to convert it into cash, sales, or use up within 1 year. In other words, these are short-term resources that company uses to fund their operation. In current asset, we found different examples. Firstly, cash and cash equivalents, like physical cash, bank balances, mobile money, and high liquidity short investments. Another example of current asset is account receivable. Account receivable, it is money owned to the business by customers who have bought goods or services on credit. It will be collected soon, usually within 1 year. This is why it's current asset, because we expect to collect it within 1 year. For example, customer buys goods of 500,000 on credit. The customer promises to pay in 2 months. That 500,000 is account receivable. Since business will get money soon, it is a current asset. Another example of current asset is the stock or inventory. Inventory is current asset because it is expected to be sold within 1 year. Short investments like a treasury bill is also current asset. It is current asset because they can be easily converted into cash within a short period, usually less than 1 year. Prepaid expense are also current asset. They are current asset because they represent payment made by business in advance for goods or services. For example, you paid 12-month expense of rent in January, but you are not yet used them up. Marketable securities are also current asset. They are current asset because it is financial assets that can be quickly sold in the market to get cash. That are bonds or shares that are listed on stock exchange. Those are some of current asset. Let's move on fixed asset. Fixed asset are long-term resources business owns not for immediate sale, but provide benefit for more than 1 year. Example of non-current asset, there are many. Let me try to list it. We found land. Land are non-current asset because it is owned for long-term use, not sold in a normal business cycle. It can be office plot, factory land, or others. Other examples of non-current asset are buildings, machinery and equipment, vehicles, furniture and fixtures, computer and IT equipments, leasehold improvements, and intangible asset. In intangible asset, we found patents, trademarks, copyrights, and software. All intangible assets are non-current assets. Another non-current asset are investment property used for business. For example, when we have office building but rented to others. Let's proceed on owner's equity. Owner's equity is the owner share of the business after all liabilities are paid. In other words, owner's equity is owner contribution in the business. What owner invested in a business or part or contribution of owner in the business. Owner's equity, in other words, you can say it is what belongs to the owner in the business. What are components of owner's equity? It is composed by 3. First, capital or owner's investment. That are money or asset that the owner puts in the business or what owner invested in the business. Secondly, retained earnings or profit. That are money the business has earned and kept, not paid out. And thirdly is drawing or withdraws. Money the owner takes out of the business that reduce equity or reduce capital. Thank you. For example, owner invests 1 million Rwandan francs as a capital, and the business earns 300,000 as profit. That's what we call retained earnings. Owner withdraw 100 Rwandan francs for his or her personal use. Owner's equity equal to 1 million as a capital plus 300,000 as retained earning minus 100,000 as drawing, because that money owner take and use it for his or her personal use. So owner's equity equal to 1,200,000 Rwandan francs. So in short word, owner's equity is what belongs to the owner in a business after paying all debts. It comes from the money owner invests and profit the business keeps minus what owner take in a business for his or her personal use. You can calculate it in accounting equation by subtracting liabilities from asset. Let's proceed on liabilities. Liability is something that business owes to other people or to other business. In other words, liability is a debt or obligation of the business. Just like asset, liability is categorized into main two types. Firstly, current liabilities. These are debts that must be paid within 1 year. Examples, we have account payable, that are money owed to supplier. Others are short-term loans, bank overdraft, salaries payable, tax payable, accrued expenses, and others. And on non-current liabilities, these are liabilities that will be paid after or more than 1 year. Example of non-current liabilities are long-term bank loans, mortgage, bonds payable, long-term lease obligations, and others. In short words, liabilities are debt or obligation of a business owes to others. If debt must be paid within 1 year, it is current liability. And if debt must be paid with more than 1 year, it is non-current liability. So, with component of accounting equation. So, we can ask ourselves question that why accounting equation must always be balanced. The accounting equation must always be balanced because everything the business owns must come from somewhere. Asset equal liabilities plus equity. As we saw, assets are what business owns. Liabilities are what business owes. And equity are owner's claim. So, for example, if a business have $10,000 cash, we must ask ourselves that where did that 10,000 come from? Maybe it can be borrowed or it can be capital of the owner. So, what business has must be equal to who financed it. Who financed it? Maybe it can be the owner or liabilities that owner takes to invest in his business. Let's take question related to accounting equation. Justin decides to open a retail shop selling greetings cards and gifts. Her uncle rents her 300,000 Rwandan francs to help her with financing the venture. Justin buys shop premises costing 500 Rwandan francs, a motor vehicle of 100 Rwandan francs, and a stock of goods of 50,000. Justin did not pay for her stock of goods in full and still owes 21,000 to her supplier in respect of them. After the event, describe the above, and before she starts trading, Justin has 1,000 Rwandan franc cash in hand and 70,000 Rwandan francs cash at bank. As a professional accountant, you are required to calculate the amount of capital that Justin invested in her business. In this question, we are not just calculating capital. We are reconstructing the financial structure of a business using accounting equation that stated that asset equal liabilities plus owner equity. So, to calculate this question or to answer this question, we must do it in a step, and as we do it many times, we will be on advanced level that we will answer it without going in further calculation. So, let's start by identifying all assets. In the question, we have shop premises of 500,000, motor vehicle of 100,000, stock or inventory of 50,000, cash in hand of 1,000, and cash at bank of 70,000. Now, let's we add asset and find our total asset. We add 500,000 plus 100,000 plus 50,000 plus 1,000 plus 70,000. And the total asset be 721,000. But here, there is something to note. We recorded stock of value of 50,000 even though it was not full paid. Why we made that? It is because that accounting records resources, not payment. So, step 2 is to identify all liabilities in our question. Liabilities that was in our question is a loan from uncle that is equal to 300,000 and amount owed to supplier that is equal to 21,000. So total liabilities are, to sum up it, 300,000 plus 21,000, that is equal to 321,000. So step 3, we are going to apply. We have got total liabilities and we have got total assets, and we are going to calculate capital. As accounting equation states, it is stated that asset equal liabilities plus capital, and capital equal to asset minus liabilities. So we must take 721,000 minus 321,000, and we get that capital equal to 400,000. Therefore, Justin invested 400,000 of her own money into the business. So, as you have seen, accounting equation balances not because accountant wanted it to, but because economic reality forced it to. So, let's proceed on double entry system. So, what is double entry system? Double entry system is accounting method where every transaction affects at least two accounts. If you debit, you credit. We are going to know what is income, what is expense. Expense are money that you spend or pay out, and income are money that you receive or generate, are money that is generated by the business. In income, can say commission received, and in expense we can say rent and others. In expense also we have, for example, electricity, rent, we have water bill and others. Actually, those are money that business spent or pay out. And in income, we have dividends. We have dividends, we have interest received, we have profit and others. So, income actually are money generated by the business. So, let's talk on secret of double entry system. Asset and expense are always debited when increasing, and they are always credited when decreasing, and expense and asset always have debit balance. And for income, liability, and capital, they are credited when increasing, and they are debited when decreasing, and income, liability, and capital always have credit balance. So let's take an example. As professional accountant, you are required to provide journal entry of the following transaction. On 1st October, started the business with a capital of 70,500 in the bank. On 4 October, bought a machine for 40,000 Rwandan francs, paying by check. On 6 October, bought office equipment for 2,250, paying by check. On 11 October, paid the rent of 4,000 Rwandan francs by check. On 12 October, obtained a loan of 30,500 Rwandan francs from a friend Grass and put the money into the bank. On 15 October, paid the wages of 5,000 Rwandan francs by check. On 18 October, received commission of 12,000 by check. On 20 October, there is a drawing of 2,500 by check, and on 25 October paid the wage of 4,500 by check.
We are now going through the answer of above question about double entry system. We are going to start by the transaction that took place on the 1st October, where the owner of the business started the business with capital of 70,500 Rwandan francs in bank. To mean that the business receives money and the bank increases as an asset, and owner's equity or capital also increases. And we all know that when asset increase, we debit. By that time, we are going to debit the bank account by 70,500 as an asset. So we are going also to credit capital by 70,500 Rwandan francs, because the capital account is always credited when it is increasing. On 4th October, the company bought machine of 40,000 Rwandan francs by check. To mean that the machine as an asset increased and the bank account decreased because we paid by bank. It means our assets on the bank had decreased through payments made. And we are going also to debit machine as an asset, because an asset, remember that it increases when debited. So we are going to debit the machine account by 40,000, and also we credit bank account by 40,000, because bank account is an asset, but here it is decreasing, and the asset decreases when it is credited. So let's move on the third transaction that took place on the 6th October, where the company bought office equipment of 20,250 Rwandan francs by check. To mean that the office equipment increased in. Remember that these equipments are in form of assets. Means when asset increases, we debit. That's why down here we are going to debit office equipment account by 20,250 Rwandan francs as an asset of equipment that increases. And we also credit bank account as an asset that is decreasing here. We are going to credit bank account by 20,250, because the bank here is an asset, but it is decreasing, and the asset decreases when credited. On 11 October, the company paid rent of 4,000 by check. So here the rent is an expense. And remember that when expenses increase, we debit. And when expenses decrease, we credit. And here expenses are increasing because they are being paid by the company. Means here we are going to debit rent expense by 4,000, and also we credit bank as an asset that is decreasing here, because we are paying rent expense by using bank. It means our bank account is reducing. So we are going to credit the bank account by 4,000 in order to obey the double entry system. And then on 12 October, the loan received of 30,500 Rwandan francs from Glass deposited in a bank. To mean that the bank increases as an asset and loan payable increases as liability. Remember that when liability increases, we credit is not as the same as an asset. So here we are going to debit bank account by 30,500 and credit loan as liability by 30,500. On 15 October, the company paid wages of 5,100 francs by check. So here the wage expense increases as an expense, and the bank decreases as an asset. To mean that the expense increases but the bank reduces. Here we are going to debit wages expenses as an expense. As we know, expenses increases when we debit. So here we are going to debit wages expense account by 5,100 francs, and we credit bank by 5,100 francs. To mean that the bank account as an asset has been reduced. So on 18 October, the commission received of 12,100 francs by check. So here the bank increases and the commission also increases. Here that's why, because we received this commission by check, it means that the money had, all assets, our assets has been increased on bank account, because the transaction is made by check. When it is by hand, we should have to debit cash account, but here we are debiting bank account because the transaction has been made by check. So here we are going to debit the bank account because our asset has been increased to bank account. And also the commission, which is an income, and income always increase when they are being credited. So here we are going to credit commission income by 12,100 francs. So this is how this transaction should be treated. And let's continue on the 20 October, where the drawings of 2,500 francs was made by check. To mean that if it's by check, it has to affect the bank account. So here the bank account is reducing or decreases because the drawings, all the money taken by the owner for the personal use, which are called drawings, has been taken to the bank. Means they use the check, the owner used the check to withdraw the money from the business account, bank account especially, and he take them for private use. So here we are going to credit bank account as an asset, reducing on the bank account of the business, and here we also debit the drawing account as an expense. So pay attention here. The drawings is treated as an expense, but it isn't as a normal expenses. It is treated as an expense, but isn't as a normal expense. So we have to debit drawing account as an expense, and we credit bank account as an asset, reducing both by 2,500 francs. And let's move on the last one on 25 October, where the company paid wages of 4,500 francs by check. Means when it is involving check, it means that it is also affecting the bank account. Here, because we paid the wages by using check or bank account, means the bank account as an asset are reducing, so that we have to credit those assets in the form of bank that are being reduced by 4,500 francs, and we also debit wages expense as an expense, increasing. Remember that expenses increases when we are debiting them. So we have to debit wages account by 4,500 francs. So I think here the answer above has been already answered well, and the double entry system has been well treated, since the one transaction is affecting two different accounts, account to be debited and account to be credited.
So, as conclusion, double entry system affects at least two accounts. If you debit, you credit. No matter how complex accounting becomes, from small businesses to CPA, ACCA, or even PhD level, it all starts with this principle. Every debit has a credit. This is a golden rule of accounting.